So today we are going to talk about monetary policy, and we have also come to the very end of the semester and the content. So if you go through the content, if you look at all the videos that we had for this semester, we started with the fundamental principles of economics, and then we built on by talking about opportunity cost. We talked about how opportunity cost determines division of labor or specialization, and we saw how specialization leads to trade and how trade leads to mutually beneficial gains from for the countries. Then we moved on to the concept of market, and we analyzed demand side and supply side of the market, brought the two together, and we looked at how the dynamics of demand and supply forces in a market could influence the market price and quantity. Then we moved on to the production side of microeconomics, and we looked at the theories of production and cost, and we briefly reviewed the different market structures. So we went over the different types of market structures, and then we finally moved on to macroeconomics, because we said that microeconomic decisions are often influenced by what is happening in the macroeconomy. So that was the objective of moving on to macro from micro. And in macroeconomics, we looked at different indicators of macroeconomic health. We looked at GDP, we looked at unemployment, and then we moved on to aggregate demand and aggregate supply model, which basically is the demand and supply model for the macro economy. And in the aggregate demand and supply model, we were able to see how output gaps may arise in an economy. And finally, in the last video, we started talking about macroeconomic policies and how macroeconomic policies may fix the output gap in an economy, how it can wipe out any recessionary gap or inflationary gap in the economy. So today we are talking about monetary policy, and with this we will be ending the semester. Once again, just like fiscal policy, please remember that the objective of monetary policy is to affect the output gap in an economy. So the objective of monetary policy is to wipe out any kind of output gap, be it recessionary gap or inflationary gap in an economy, and it would wipe out the gap by adjusting a short run equilibrium to a long run equilibrium, and that would happen through the demand route. So just like fiscal policy, the monetary policy also affects the aggregate demand or AD of the economy. So that's the basic similarity between fiscal and monetary policy, that is both fiscal and monetary policy only affect the aggregate demand. So in some sense, these two policies are aggregate demand shifters. They do not affect the aggregate supply of the economy. Now, monetary policy has only one tool. If you remember, fiscal policy had two tools, that is government spending and taxes. Here, monetary policy has only one tool, and that is the money supply, which we are denoting as MS. So money supply. Money supply is the one and only tool of monetary policy. And there is also another difference with the fiscal policy. The fiscal policy, the execution of the fiscal policy depends solely on the discretion of the government. That is, whether the government wants to increase G, whether it wants to decrease T, whether it wants to increase T or decrease G, whatever it needs to do with those two tools, it is the discretionary power of the government. However, in case of monetary policy, it is the central bank of a country that deals with monetary policy. In case of United States, the central bank of United States is the Federal Reserve. So it is the Federal Reserve which is responsible for executing the monetary policy. So the Federal Reserve decides what kind of monetary policy is needed at that point. Of course, there is implicit consultation with the government, with the federal government, but it is the execution of the monetary policy in an economy takes place through the Federal Reserve. And just like fiscal policy, you also have two kinds of monetary policy. One is expansionary. So expansionary monetary policy and contractionary monetary policy. Now, to understand how money market impacts the economy, how money supply impacts the economy, it is important to understand how a money market works in an economy. So, before we even go on to this part and see how money supply plays an important role in wiping out the output gap in an economy, let us understand the dynamics of the money market. So, let us talk about the money market. So, we have a two-dimensional diagram. So, I am drawing a diagram for the money market. So, here the commodity that we are dealing with is money. Now, please note that this is not a macroeconomic demand supply model here, right. So, I have the market for one particular commodity, which is money. So, in that sense, it is a micro diagram, it is a microeconomics diagram, because if you remember, that was the basic difference between demand and supply model in microeconomics and macroeconomics, right. In microeconomics, we were concerned about the market for one commodity, one particular good at a time, and that market could be market for apples, it could be a market for ice cream, or it could be a market for textbooks. But in macroeconomy, we could not identify one particular commodity, it was the market, the entire aggregated market of the economy. It was a market for all final goods and services produced in an economy, right. So, here we are kind of going back to our micro concept of demand and supply, and we are looking at one market at a time, and this market is the market for money, okay. So, what you have here is quantity, and it is basically the quantity of money that you are measuring in the economy. So, it is the quantity of money in the economy, let us denote that as QM. So, this basically tells you what is the total amount of money in circulation in the economy. What is the total volume of cash? You can conceive of this as cash. What is the total volume of cash in circulation in the economy? That is what is being measured on the x-axis. Obviously, here we need to put the price of money. Now, that sounds a little weird, the price of money. What is the price of money? Because if you go onto the market, you cannot buy $10 by paying another $50, or you couldn't buy $100 by paying another $200. We never do that, and we haven't heard about that. Then what is basically this price of money? Now, what is the price of anything? If I ask you what is the price of a t-shirt, the price of the t-shirt is maybe $10, the $10 that you have paid to buy that t-shirt. Now, there is another way that you could conceive of those $10. Now, those $10 is something that you sacrificed in doing something else, right. So, you bought the t-shirt, but you could have used those $10 in doing something else. So, maybe you could have watched a movie. So, in some sense, the price of the t-shirt is the pleasure that you gave up by not watching the movie, right. So, your sacrifice of not watching the movie is also your price of buying the t-shirt. So, what I am talking about here is really the concept of opportunity cost, if you remember, right. Opportunity cost is the sacrifice that you make in getting something, right. So, here if you are buying the t-shirt for the $10, then you are sacrificing the opportunity of doing something else with those $10. So, the same concept holds here. Since we really cannot find out a dollar price for buying money or selling money, what the price of money really is the opportunity cost of holding money or the opportunity cost of holding cash. So, let us try to make this a little simple. Let us say you have $100. So, if you have $100, you really have two options. You could spend those $100, or you could save and invest those $100, right. When you spend those $100, you buy goods and services out of it, right? You pay for the goods and services. If you save or invest those $100, then you have the opportunity of earning a return. If you put the $100 in a bank, in a savings account, then you have the prospect of earning a rate of interest, a return, right? Because most savings accounts nowadays are paying some interest rates, some more than others, but there's a prospect of earning some return on those $100 if you choose not to spend it, and instead if you choose to save or invest it. So that means whenever you are spending the $100, you are giving up the prospect of earning this return. So this return is the price of that spending, or it is the price of spending money, if I may say so. So if you look at it in that way, then the price of holding money is R. The price of not saving money is that R, because it is your sacrifice, it is your opportunity cost, where R is basically the rate of return or rate of interest in the economy. And I told you, for simplicity, we are assuming that there is only one rate of interest in the economy. So R stands for the rate of interest. Once again, let me kind of explain why we have that R there, and this is a very important thing for you to understand. If you hold money, if you hold cash, whether you spend it or you keep it under your pillow or you put it in your wallet, as long as you are holding on to the cash, as in you are not saving that money, you are basically giving up the opportunity of earning any return on that money. If you put a $100 bill under the pillow, it's not going to fetch you any return. If you put it in your wallet, it's not going to fetch you any return. If you spend it on goods and services, it's not going to fetch you any return. So the cost of holding cash is the prospect of earning that return, right? So that is the price of holding money, the rate of interest. We have a demand curve for money, which looks like that. Let's call that DM. So the demand curve for money, it looks like the demand curve for any other commodity. It is downward sloping, which basically means that if the rate of interest is high, then the demand for cash is low. As you can see, if the rate of interest is high, then the demand for cash is low, which is true, right? If I get 10% return by putting my money in the savings account, then I'm going to put my money in the savings account and not hold as cash. My demand for cash will be low. And if the rate of interest is low in the economy, then the demand for cash is high. If I get only 0.2% return at the bank, then I rather hold the money as cash and not put it in the bank. That is exactly what you have seen over years in the US economy. The banks have been paying such low rate of interest, 0.01%. If you put it in the savings account, people have no incentive to keep their money in the savings account. They rather keep it in their hands and they'd rather spend it in the economy, right? So there are reasons why the government has done that, why the interest rate has been really low in USA. There are other reasons, attached to that. We are not going into the good or bad of that, but I'm just saying that if the rate of interest is low, then the incentive to hold money and not put it into investment and not save that money is also kind of high. People would like to hold money as cash, okay? So you can see that, and that is why you have a downward sloping demand curve. So basically, when the opportunity cost of holding money is high, then people will hold less money, and when the opportunity cost of holding money is low, then people will hold more money. Okay, that's what I'm saying. So R is basically the opportunity cost of holding money, and you can think about this as cash, money or cash. When you think about this as cash, it becomes a little easier to understand. Okay, it's the opportunity cost of holding money or cash. When that opportunity cost is high, then the incentive to hold money is less. When the opportunity cost is low, then the incentive to hold money is more. Okay. Now, it is not enough just to have the demand curve, as you know, because we are drawing the picture for the money market. So obviously we need a supply side. So we need a curve for the supply of money. Now, the supply curve for any other commodity is upward sloping, as you know, mostly textbooks, ice creams, apples, oranges. But for the money market, the supply curve is not upward sloping. Instead, the supply curve is a vertical line. And the reason for that is that at any point in time, at any given time, the supply of money is a fixed number, and that number is determined by the Federal Reserve Bank. So that means the citizens, people like you or me, or the government, or the business firms, or the households do not have any control on the supply of money. We can only influence the four sectors of the economy: the foreign, the business firms, the households, and the government. These four sectors of the economy can only influence the demand for money. We cannot influence how much cash or how much money is circulating in the economy. We have no control over it. That is being controlled by the Federal Reserve, and the Federal Reserve decides that, okay, on June 14th, this is going to be the supply of money in the economy. Okay, so this is a fixed number, and that's why it's a vertical line, because no matter what happens to the rate of interest, no matter what happens on the y-axis, this does not change. It's a decision by the Fed. Okay, so you have a vertical supply curve for money, and at the intersection of that demand and supply curve, you have the equilibrium in the money market. So from there you are getting the equilibrium rate of interest, and you are getting the quantity of money in the economy, which is a fixed number at that point in time. So that quantity has been determined by the Fed. Okay, so this is your picture for the money market. Now obviously I told you that the demand for money is influenced by us, and it is influenced by the four sectors of the economy. So what are the factors that can change the demand for money? Okay, obviously there are some things. What are the money demand shifters? What are the shifters of demand for money? First of all, price level in the economy, right? If prices become expensive in the economy, if there is inflation in the economy, then obviously we need more money to buy our goods and services, so we will demand more cash. Yesterday, if you could buy your vegetables for $10, and today if the same vegetables become $20, then obviously you need another $10 bill today. So your demand for cash or your demand for money is increasing. So higher price level, if the price level goes up, then your DM, that is demand for money, goes up, and you see a right shift of that demand curve for money. So you will see something like that, a right shift to something like DM dash, and as a result of that your rate of interest will be going up in the economy. Okay, the opposite will happen if your rate of interest will be going up. Okay, now the opposite will happen if there is a decrease in the price level. If there is a decrease in the price level, then your demand for money or your demand for cash will be lower. Then you will have a left shift of the demand curve for money, and as a result of that your rate of interest will be lower, right, in the economy. Now there are some other factors that can also influence the demand for money, something like banking technology, or number of banks. So basically how developed the banking institutions are in your country. Now if you have more number of banks, if the banking sector in your country is extremely developed, the commercial banking sector, it means that there is more opportunity for you to keep your money in the bank rather than keep your money as cash, right? So if you have more banks, then there will be a lesser demand for cash or a lesser demand for money in the economy. So your demand curve for money will be shifting backwards, it will be shifting leftwards. Okay, please understand, if you have more banks, there is more opportunity to keep your money in the bank, and there is less need for holding cash. So the demand for cash will be lower, so the DM curve will be shifting leftward. Okay, now what do we mean by banking technology? By banking technology we mean things like ATMs, right, teller machines, if you have more ATM machines, if you have things like, have you heard about Venmo and PayPal, all those online platforms where you can, transfer your money and you don't even need a card. You could just set up an account and you can attach a bank account or a credit card to it, and you can just, finance your transactions through those platforms. Correct? So the development of all that technology, the development of online platforms like Venmo and PayPal and all of that really reduces the need for money or the need for cash. So that would all translate into a fall in the demand for money, DM, and the DM curve would shift leftward. Same for ATM machines. If you have more ATM machines everywhere, then you don't need to keep the money in your wallet. You can just, withdraw the money from an ATM machine at any time. So your demand for cash will be really low. So your demand curve would be shifting leftward. If I ask many of you how much cash are you holding in your wallet right now, some of you will have $2, $5, $10, $20 maximum. We don't need to carry hundreds and hundreds of dollars in our wallet anymore, right? So all this technology has basically reduced the demand for money. So that DM curve shifts backward. So basically all these factors can influence the demand for money in the economy, and whenever there is an increase in the demand for money, that's going to take the rate of interest up, and whenever there is a decrease in the demand for money, that is going to take the rate of interest down. Now please note that the demand for money has nothing to do with the monetary policy, because remember what I told you a couple of minutes back, right? The monetary policy is executed by the Federal Reserve. We have nothing to do with the monetary policy. We as citizens of the country cannot influence the monetary policy. We cannot influence the supply of money. We can influence only the demand for money. Okay, so whenever there is a change in the demand for money, the Federal Reserve is not playing any role, and hence the demand for money is not referring to monetary policy. So far in this diagram, we have not spoken about monetary policy at all. We are just talking about the money market, and we are just talking about changes in the demand side of the money market, which is influenced by us. Okay, so we have said that whenever there is an increase in the demand for money, there is an increase in the rate of interest in the economy, and whenever there is a decrease in the demand for money, there is a decrease in the rate of interest in the economy. Once again, I want to reiterate that this has nothing to do with monetary policy. This is just dynamics in the demand side of the money market. Okay. Now once that happens, if the rate of interest in the economy is going up or down, this basically kicks in the interest rate effect. If you remember, we covered the interest rate effect when we talked about it in the ADAS chapter. If you do not remember this, please go back to that video and refresh your memory where we discussed interest rate effect. Right, I'm not going to go into the details of this effect in this video. You can go back and watch the video on ADA's model. I talked about it there in detail. Okay, so any change in the rate of interest in the economy will kick in the interest rate effect. Whenever the rate of interest goes up, as a result of that, there will be a decrease in investment, and there will be a decrease in consumption, and as a result of that, the aggregate demand for the economy will be going down. And similarly here, as rate of interest goes down, there will be increase in investment, and there will be increase in consumption, as a result of which the aggregate demand for the economy would be going up. Okay. And as aggregate demand goes down, real GDP would be going down, so there will be more unemployment in the economy. As aggregate demand goes up, real GDP will be going up, so there will be decrease in unemployment in the economy. So all that is going to happen in the macro economy as a result of what happens on the demand side of the money market. Please note that this part is happening in the money market, on the demand side of the money market, and the rest of it is taking place in the macro economy, and this is the impact, the final impact on the macro economy. But once again, please note that none of this has any bearings with the monetary policy. We are not talking about monetary policy yet. We are just talking about the demand side and how the demand, changes in the demand for money can influence the macroeconomy. That is what we are talking about here. But now, next we are going to move on to the supply side and see how the supply side influences the economy, how the changes in money supply will influence the economy, and that is where we will have the role of Federal Reserve coming in, and that is where we are going to talk about monetary policy. So please be very clear, the demand side of the money market is not monetary policy. It's the supply side of the money market which talks about the monetary policy. Okay, let's go on to that. So next we are going to talk about the supply side of the money market, like I told you. So once again we will go back to our diagram for the money market. And we have the rate of interest here. We have the demand curve for money DM. And we have the supply curve for money MS. The intersection point of the two is the equilibrium of the money market, and at that equilibrium we have the equilibrium rate of interest. Let's call that R star, and that's the quantity of money in the economy which is fixed at a certain point in time. So in the previous diagram we talked about how the changes in the demand curve could influence the rate of interest and how it could finally influence the macroeconomy. Now we are going to talk about the supply curve. Now I told you that this supply of money is a fixed amount at a certain point in time, and who decides this fixed amount? It is the Federal Reserve. For United States it's Federal Reserve, for any other country it would be the central bank of that country. Okay? So they decide on the supply of money. Now having said that, it is the Federal Reserve who can think, who can really change this supply of money. The Federal Reserve can think in another month that okay, we are going to increase that supply of money, and in another 5 months they could think that okay, we are going to decrease that supply of money. Of course, depending on the macroeconomic situation of the country, it does not depend on their whims and fancy. They are looking at different indicators in the economy and deciding whether they should raise the amount of money or decrease the amount of money, but at the end of the day it is the Fed's decision. Okay. So whenever the Fed decides to increase the supply of money, obviously they are deciding on a quantity bigger than this. So that would move the quantity in that direction, which means that the money supply curve would move to the right to something like MS dash. So that is an increase in the supply of money. So whenever there is an increase in the supply of money, the money supply curve will move in that direction. And whenever the Fed decides to decrease the supply of money, then obviously that curve will move in the leftward direction, because then the quantity is moving in the opposite direction. So we have something like MS double dash, and by MS double dash we are referring to a left shift. So basically we are talking about a decrease in the supply of money here. So an increase in the supply money is going to shift that curve to the right, and a decrease in the supply of money is going to shift that vertical curve to the left. And we will still have fixed quantity of money in the economy, right, because that is still a fixed number. It is not a dynamic number. It does not depend on the rate of interest, but that fixed number is decided by the Fed, and that fixed number in this case is bigger than the previous fixed number, and this fixed number in that case is smaller than the previous fixed number. That is what I mean. Okay, but it is still a fixed number. Let's say that number is $100 today, tomorrow it could be $200, but it is still exogenously given by the Fed. It does not depend on any other indicator. So in that sense I am talking about it as a fixed number. Do not get confused here. Okay. So whenever there is an increase in the supply of money, please note that the rate of interest in the economy drops to something like R dash, and whenever there is a decrease in the supply of money, then the rate of interest in the economy rises to something like R double dash. So I could say that an increase in the supply of money decreases the rate of interest in the economy, and a decrease in the supply of money increases the rate of interest in the economy. That is what happens. Okay, we can see that clearly here from this diagram. Now, whenever there is this increase in the supply of money, this is known as expansionary monetary policy. So, an increase in money supply is called the expansionary monetary policy, and a decrease in the supply of money is called the contractionary monetary policy. So, that means an expansionary monetary policy will lower the rate of interest in the economy, and a contractionary monetary policy will increase the rate of interest in the economy. And once again, this change in the rate of interest will kick in the interest rate effect. If you do not remember this, go back to the ADA's video, please. Okay. This will kick in the interest rate effect. This change in the rate of interest, whether it's expansionary or monetary or contractionary, it will kick in the interest rate effect, and in this case the lower rate of interest will lead to a higher investment, and it will lead to a higher consumption, and as a result of that there will be an increase in AD, and there will be an increase in the real GDP of the country, and unemployment level will be going down. Okay. Similarly here, as rate of interest goes up, now investment will be going down, consumption will be going down. If you are not following how these are going down, you need to go back to that ADA's model video, please, and take a look at what we mean by interest rate effect. Okay. And as a result of this, the AD or aggregate demand will be going down. So, real GDP will be going down, and there is an increase in the unemployment in the economy. Okay. Now, this part you can see that this is looking similar to what we just talked about on the demand side. Well, that is true, but here when we are talking about the impact on money supply and hence the impact on the economy, we are talking in terms of monetary policy. That is the basic difference. Now, we are talking about monetary policy because it is the supply of money that is driving that change. Okay. And how will it look in the macro economy? In the macro economy, if you have the ADA's diagram, if I go back to my macroeconomic diagram, this is my ADA's model diagram, right. So, I have my RGDP here, I have my LRAS, I have my AD curve, let us call that AD1, and I have my SRAS curve, let us call that SRAS1. So, that is a recessionary gap in the economy. Okay. Similarly, I could have an inflationary gap in the economy also. So, this is just an ADA's model diagram that I am drawing, right. So, in this case, I have a recessionary gap here and I have an inflationary gap there. This is something we have already covered, so I do not need to kind of go into the details of that. So, I just want to show you how this translates into this diagram. So, you have an increase in the supply of money, your money supply curve shifts to the right, something like that black line, your rate of interest goes down. So, your rate of interest has gone down. As a result of that, your interest rate effect kicks in. As a result of the interest rate effect, your investment rises, consumption of the household rises, so aggregate demand rises. Okay. And as aggregate demand rises, in this diagram, what you see is a right shift of this aggregate demand curve to something like AD1 dash. Please note, this is similar to the fiscal policy chapter, and as a result, we have moved from this short run equilibrium to a long run equilibrium, and your output gap has been wiped out because the economy has gone to that potential. Right. So, your expansionary monetary policy removes a recessionary gap. So, that means the expansionary monetary policy should work during a recessionary gap in the economy. That is the right time to execute an expansionary monetary policy. Okay. Now, if your money supply goes down, then this curve shifts to the left, something like the red line. As a result of that, the rate of interest in the economy rises. That is what we are talking about here. Due to that, the interest rate effect kicks in. So, your investment and consumption go down, your aggregate demand goes down. As a result of that, your real GDP goes down, right. So, we are talking about a decrease in aggregate demand, and that should be shown by a left shift of that aggregate demand curve to something like AD2 dash, okay, something like AD2 dash, and as a result of that, now you are moving towards the left side, and that movement will continue until the economy comes to that point and a long run equilibrium is established. So, the contractionary monetary policy basically wipes out eventually. If you keep doing it in phases, it will wipe out the inflationary gap in the economy. So, the contractionary monetary policy should be taken during an inflationary gap. And for how long that expansionary policy or a contractionary policy needs to be done just depends on how deep that gap is. It just depends on the extent of the gap. Okay, if it's a large gap, then you need to do it over, several times. If it's a small gap, then it gets wiped out by doing one shot. So, that's the whole idea of expansionary or contractionary monetary policy. But before we kind of wrap up the chapter, let us understand how will the Fed know that it should do an expansionary policy, and once it knows that okay, we have to do an expansionary policy, what should the Fed do? Or in other words, what is the mechanism of increasing the money supply or decreasing the money supply? The mechanism of increasing or decreasing the money supply is known as open market operation. Open market operation by the Fed, also called OMO. So, this is the process for executing the monetary policy. In other words, this is the process for increasing or decreasing the supply of money. The Federal Reserve has an open market operation committee which sits in New York and meets 8 times every year, and they decide whether they should increase the supply of money or decrease the supply of money. Now, what do we mean by open market operation? Open market operation basically means the buying or selling of federal bonds, which are also called treasury bills or T-bills. That is open market operations. Treasury bills or T-bills are bought and sold. That is open market operation. It is the process of buying or selling of T-bills. And it is through this buying or selling of T-bills that Fed is able to increase or decrease the supply of money. Now, let's say the Fed is buying the T-bills. Who does it buy it from? From the citizens, right? So, if the Fed buys the T-bills from the citizens, then please understand that the T-bills are coming from the citizens to the Fed, and money is going from the Fed back to the citizens. So, the supply of money in the economy is rising. Okay, let's kind of try to understand this. So, let's say this is the Fed and this is the economy, as in the citizens, right, USA. Okay. If the Fed buys T-bills, then what is happening? Then money is going in the reverse direction. The T-bills are coming. The T-bills are coming in this direction, and the money is going from the Fed to the economy, isn't it? Money is going in that direction. So, buying of the T-bills will increase the supply of money in the economy because money is going into the economy, if you understand this, right. The opposite will happen if the Fed sells the T-bills. So, now if the Fed sells T-bills, what is happening? The Fed is selling, so the T-bills are going to the economy, right. So, now T-bills are going to the economy, and money is coming out of the economy to the Fed because the Fed has sold. So, money is coming from the economy to the Fed. As a result of that, the supply of money in the economy is going down. Okay. So, can we say from that that if the money supply is increasing, that increase in the money supply is brought about by the buying of T-bills or purchase of T-bills, and this decrease in the supply of money, this happens through the selling of T-bills. So, an increase in the supply of money or an expansionary monetary policy, this is basically brought about by buying of T-bills, and a contractionary monetary policy, this is brought about by selling of T-bills. Okay. So, now this picture is complete. So, now if the Fed wants to do an expansionary monetary policy, it has to buy T-bills, so the money supply curve will move to the right, so the rate of interest will go down, so the rate of interest effect will kick in, so I and C will go up, AD will go up, real GDP will go up, unemployment will go down, and the recessionary gap will be wiped out from the economy. And the same thing would be true for contractionary monetary policy. So, it all starts with the open market operation. Okay? That is what starts the process of monetary policy, and all that you have on the board right now tells you about the working of monetary policy. And I want to remind you again that the demand side of the money market may have the same impact on the economy, but that is not talking about monetary policy in the economy. Okay? This is talking about monetary policy.